Have you ever watched a perfectly calm ocean suddenly churn into a rogue wave? Picture this. It's late afternoon on Wall Street, the sun's golden glow streaming through towering glass windows. You're leaning over your monitor at exactly 3:14 p.m., tracking a blue line that's been inching steadily upward all day, until, in the blink of an eye, it rips straight down like a crimson slash across the screen. No warning bells sound, no flashing banners scream, "Sell!" Yet your heart skips a beat as the price plunges 5% in a single heartbeat. Imagine the hush that falls over the trading floor, broken only by the soft hum of fluorescent lights and the distant chatter of analysts resetting their screens. You lean in closer, eyes darting across the order book, and you realize something doesn't add up. Thousands of buy orders appear in the blink of an eye, anchoring the bid side, then vanish without a trace. It's as if ghosts are dancing among the numbers, luring you into a trap. Tonight we're pulling back the curtain on these phantom maneuvers, ghost trades executed by high-speed algorithms that slip in and out, buying and selling in shadows so brief the human eye can't catch them. These aren't random glitches or chance hiccups. They're calculated strikes by automated programs designed to manipulate supply and demand at the speed of light. Think about your favorite stock. Imagine an invisible hand flicking the order book, baiting investors with fake demand before yanking the rug out from under them. You, me, thousands of everyday traders, all caught in the crossfire. By the time you spot the pattern, it's over. The price has already snapped back, but the damage is done. Just last year, one algorithmic trader unleashed hundreds of thousands of phantom orders in milliseconds, netting millions before regulators even blinked. Or consider the tale of a small hedge fund manager in Chicago who lost 20% of his fund's value in under 20 seconds, all because a rival's code triggered a cascade of ghost bids and withdrawals. So, why should you care? Because high-frequency trading isn't just Wall Street's playground, it's your playground too. Your retirement account, your college fund, even that occasional stock you bought on a hunch, all of it can be skewed by these electronic specters. In the next half hour, we'll journey into the heart of this digital phantom market, unravel the mechanics behind ghost trading, and uncover what it means for anyone with even a single share in their portfolio. Before we dive into the nuts and bolts, let me ask you, what if I told you that half of all equity trades today involve orders placed and canceled before a human could type buy? What if those phantom orders aren't accidental, but weapons in a silent war for market control? By the time we finish, you'll see the markets in a whole new light, one where speed is power and invisibility is profit. Buckle up. The rules you thought governed fair trade are about to be rewritten in code. Welcome to the world of ghost trading. Imagine a massive cathedral of glass and steel perched on the edge of Manhattan, humming with electricity and the low drone of thousands of processors. Inside, rows of servers flash in hypnotic rhythm, each one running thousands of lines of code that send orders racing across the country in microseconds. This is the nerve center of modern finance, where high-frequency trading firms battle in a game of milliseconds and nanoseconds. To understand ghost trading, we have to step behind the scenes of this digital coliseum. It all began in the early 2000s, when exchanges embraced electronic limit order books and automated matching engines. Suddenly, human traders typing orders on phones and once manual systems could not keep up. A new breed of trading strategy emerged, algorithmic programs that sniffed out tiny price discrepancies across venues, racing to capture fractions of a penny before the rest of the market even knew what happened. With the advent of co-location, renting space in the same data centers as exchange matching engines, firms shaved precious microseconds off their communication time. Imagine two runners at the start line, but one starts a blink of an eye sooner. In the world of HFT, that blink is everything. Now picture the order book itself, a live updating scroll of bids and offers, like a digital seesaw teetering back and forth. On one side, you have buyers willing to pay a certain price, on the other, sellers eager to offload shares. In between, invisible algorithms lurk, constantly probing both sides for weakness. They spot a large bid at $50.05 on one exchange and a slightly lower offer at $50.04 on another. In a puff of code, they buy at the lower price, simultaneously sell at the higher, pocketing the tiny spread. Multiply that by thousands of shares and countless trades per second, and suddenly those pennies add up to millions. But this is not just about arbitrage. Ghost trading takes advantage of the dynamic nature of the order book itself. Imagine an algorithm that sends out a flurry of buy orders at the front of the line, each one tempting other participants to widen their bids. Then, without executing a single share, it retracts those orders in microseconds, leaving the rest of the market scrambling to recalibrate. It's like shouting, "Fire!" in a crowded theater, only to vanish before anyone realizes the shout was a decoy. These phantom orders create artificial liquidity signals, manipulating both price and sentiment. Regulation tried to keep pace. In 2005, Regulation National Market System mandated faster communication and transparency, hoping to level the playing field. Instead, it fueled a technological arms race. Market participants installed fiber optic cables across frozen lakes in Minnesota to shave off microseconds of travel time. They commissioned private microwave networks and even experimented with laser beams between data centers. It sounds like science fiction, but in the world of high-frequency trading, it's standard fare. To ground this in real-world numbers, consider that the average human reaction time to a visual cue is around 250 milliseconds, hardly a contest when you're up against machines acting in micro and nanoseconds. During the infamous flash crash of May 6, 2010, a massive sell algorithm triggered a liquidity vacuum. Prices on some stocks plunged by more than 90% in minutes before rebounding just as quickly. That event exposed how thin and fragile market liquidity can be when algorithms begin to feed on each other's signals. Ghost trading plays a subtler game, injecting imperceptible ripples that go unnoticed until the aftermath crystallizes in your P&L statement. Behind every blink and you'll miss it order lies code written by quantitative researchers, PhDs in mathematics, physics, computer science, working in sterile, neon-lit offices. They backtest strategies on mountains of historical data, fine-tuning models for every conceivable market condition. When the New York session opens, their dashboards light up. A surge of green indicates profitable signals, red flags, wrong turns. Yet in this silent war, mistakes can be catastrophic. One misplaced decimal or a server glitch can trigger a cascade of unintended trades. Ghost trading algorithms, by their nature, must remain agile, retracting orders instantly if the market moves against them. Let's zoom out to see how these tactics reshape everyday investing. Imagine you place a simple market order to buy 1,000 shares of a popular technology stock. Your broker routes that order to the exchange with the best available price, or so you think. In reality, sophisticated middlemen known as wholesalers may internalize your order, matching it against their own pools or routing it based on hidden rebates. Meanwhile, ghost traders have already seen that liquidity momentarily bulge and withdraw their bids just as your order hits the book, widening the spread and increasing your execution cost. You pay more, they profit, and the market smiles on. Of course, not all ghost trading is malicious. Some firms argue they're simply providing fleeting liquidity, improving market efficiency by scouting for large hidden orders and maintaining tighter spreads. Yet when liquidity disappears at a critical moment, say during a major economic announcement, retail and institutional investors alike can be left stranded, unable to execute trades at expected prices. That phantom liquidity feels very real when it vanishes beneath you. In response, regulators have ramped up enforcement against spoofing, intentionally placing and canceling orders to deceive other participants under the Dodd-Frank Act. Spoofing carries steep fines and potential criminal charges. But ghost trading often skirts the legal definition because it doesn't explicitly intend to execute trades. Instead, it alters the behavior of other algorithms and human traders. It's a gray area that keeps lawyers busy and leaves investors bewildered. So when you log into your brokerage account and see a sudden flurry of order book updates, remember, those aren't just numbers. They're signals in a digital battlefield where speed, stealth, and strategy trump raw capital. The next time your screen flickers with phantom bids, you'll know you're witnessing an unseen hand at work, one that profits not by holding shares, but by manipulating the very structure of the market. In the next module, we'll unpack how these ghostly moves translate into real-world losses and profits, dissecting the core mechanics and case studies that expose the true impact of high-frequency ghost trading. Stay tuned. First, let's peel back the layers of how ghost trading algorithms actually operate. Picture the order book as a crowded highway at rush hour, with cars, your buy and sell orders, jostling for position. Now imagine a sleek, high-performance vehicle weaving in and out of lanes, flashing its headlights to make others give way, then vanishing before anyone can grasp its license plate. That's a ghost trader. At the heart of the strategy is something called order book probing, tiny packets of orders sent out to test for hidden liquidity and to gauge the depth of interest at various price levels. These orders aren't placed to be executed. They're probes, decoys designed to elicit a reaction from other participants, both human and algorithmic. You might hear your screen click as thousands of these probes fire off in the first few microseconds of the trading session, each one a question. Who's out there? How deep is your bid? Do you really want shares at this price? If the market responds by tightening the spread or shifting the visible depth, the ghost trader records that intelligence and adjusts its next move. In the blink of an eye, it might dispatch a second wave of probes, this time nudging the mid-price upward just a few ticks to see if it can spark a cascade of follow-on orders. Those tiny ticks are the bread and butter. Move the price by half a cent, and you've just created a ripple that real orders will chase. Behind this probing is a complex feedback loop. Algorithms analyze every cancellation, every partial fill, and every unexplained jump in volume. They watch for patterns, a cluster of canceled bids at the same price level, an unexpected cluster of iceberg orders, large hidden orders that reveal only a fraction of their size, or sudden shifts in quote durations. Together, these signals feed into machine learning models that adapt in real time, constantly refining their tactics based on the market's pulse. It's like a boxer studying his opponent's stance and jab patterns, except this boxer's fists are streams of code, and his ring is the global network of trading venues. Now consider latency. In traditional trading, you click buy and wait for confirmation, maybe a few hundred milliseconds. With high-frequency systems, the goal is to cut that delay to microseconds. Firms co-locate their servers within the same data centers as exchange matching engines, connect via direct microwave links instead of fiber, and even optimize hardware with custom FPGA chips that execute code faster than any standard processor. When your probe hits the exchange, the ghost trader knows in less than 10 microseconds whether it succeeded or not. If it didn't, the order is immediately withdrawn, often before it ever appears on another trader's screen. You'll see only the faintest blip in your depth chart if you catch it at all. This stealth is vital. The whole point is to be seen, but just barely. You want to cast a shadow without revealing your shape. If you leave your footprint too long, other traders will sniff out the pattern and either avoid your trap or bait you into overcommitting. That's where dynamic order sizing and randomized timing come in. Probe sizes vary between 100 and 1,000 shares, and intervals jitter by a few microseconds each time. No two probes follow the exact same path, making it nearly impossible to fingerprint a single ghost trader. But probing is only step one. Once the algorithm identifies a zone of passive liquidity, say a cluster of resting buy orders at $50.10, it gears up for momentum ignition. In this tactic, a sudden burst of genuine orders surges through, pushing the price up rapidly. The ghost trader then parades more probes at incrementally higher prices, reinforcing the illusion of a strong bid and coaxing other participants to chase the move. As those real orders flood in, the algorithm flips its position, unloading its accumulated shares at a profit. The result is a miniature price spike, perhaps just a few cents, that nets hundreds of thousands of dollars when multiplied across multiple instruments and replicated hundreds of times per day. Contrast that with classic spoofing. There, the intention is to cancel orders before execution while luring others in. Ghost trading sits in a gray zone. The probes aren't meant to fill. You can't accuse an algorithm of spoofing if it never truly attempts execution, but the impact on you, the end investor, is the same. You see the bid move and you chase. You see the offer widen and you retreat. By the time you realize the water's been muddied, the ghost trader has washed its hands clean, leaving you holding the wrong side of a trade. To quantify this, let's look at some hard data. High-frequency trading accounts for roughly 50% of all U.S. equity trading volume. Within that, ghost trades, orders placed and canceled without intent to execute, make up over 80% of total order traffic, though they result in less than 5% of actual trades. That means for every executed share, 16 ghost orders blink in and out of existence, cluttering the book and sapping your market's clarity. You're paying for that confusion in wider spreads and slippage. Studies show that retail investors on average lose 2 to 3 basis points extra per trade when ghost orders dominate the book, amounting to hundreds of millions of dollars a year across all retail accounts. Next, let's explore core case studies that illuminate the stakes. In February of last year, during a routine earnings announcement from a large banking institution, the stock initially dipped on news of lower-than-expected net interest margin. Algorithms detected the dip and unleashed a torrent of ghost bids, artificially propping the price back up by 0.5%. Human traders saw the rebound and interpreted it as a sign of underlying strength, piling in with real buy orders. A few milliseconds later, the ghost bids evaporated, and the price plummeted again, right into the stops of those who'd chased incorrectly. One prop desk reportedly lost $12 million in seconds, forced to liquidate long positions at a steep loss. In another example from the commodities world, an ETF tracking industrial metals experienced erratic flashes during an afternoon lull. A talented quant team traced the pattern to a single algorithm that, over 2 hours, placed 30,000 ghost offers at slightly above the market price. Each time a real buyer surfaced, the algorithm sold a small tranche at that premium, then replaced the ghost offers a few ticks higher, causing the ETF's price to oscillate by up to 0.4% every few seconds. By the session's end, the firm cashed in $5.2 million, all without holding any materially net position. These patterns surfaced only after careful forensic analysis of order-level data, far too late for most market participants to react. Now that we've seen the mechanics and some headline cases, let's turn to the data that drives decision-making. Key performance metrics for ghost trading strategies include fill-and-kill ratio, the percentage of orders canceled versus executed, average resting time, often under 200 milliseconds, and the average price improvement captured, usually 1 to 3 cents per share. Firms monitor these in real time with dashboards that highlight if cancellation rates climb above 95% or if resting times stretch over 500 milliseconds, both red flags indicating either a bug or a shifting market regime. On the flip side, exchanges and regulators track similar metrics to detect potential malfeasance. Unusual spikes in cancellation ratios, especially around scheduled economic releases, can trigger circuit breakers or flag accounts for manual review. Yet there's always a cat-and-mouse game. As soon as exchanges tighten rules, algorithms evolve. They can throttle back during risk hours, use randomized cancellation patterns, or spread activity across multiple correlated symbols to stay under detection thresholds. Beyond raw algorithmics, there's the broader ecosystem of intermediaries, dark pools, internalizers, and payment for order flow brokers. Ghost traders exploit these too, sending probes to multiple venues simultaneously to compare hidden liquidity levels. If a broker internalizes your order at a slightly worse price because ghost orders widen the apparent spread on lit exchanges, you, the retail investor, are none the wiser, yet your execution cost increases. This multi-venue probing amplifies the footprint of ghost trading far beyond a single stock or exchange. To bring it all together, consider that in a typical trading day, a high-frequency shop might deploy hundreds of distinct ghost strategies across equities, ETFs, futures, and foreign exchange. Each strategy exploits a niche. One looks for stale quotes after periodic auctions, another tracks imbalance signals around large block trades, yet another hunts for arbitrage opportunities among cross-listed securities. They all share the same tools: tiny, fleeting orders, lightning-fast execution, and adaptive learning models. But the collective effect is a market landscape peppered with mirages and optical illusions. So, what does this mean for you, the everyday trader? First, treat every quote with a grain of salt. If the bid or offer seems to flicker too quickly, resist the urge to chase. Second, lean on limit orders when possible. They can help you avoid the worst of the slippage caused by ghost liquidity evaporating. Third, pay attention to your broker's execution reports. If fills consistently occur at the worst end of the spread, ask questions about payment for order flow arrangements and internalization practices. By understanding the core mechanics and the scale of ghost trading's footprint, you gain a critical edge. You start to see the pattern of opening gambits and feints, the ebb and flow of hidden liquidity, and the telltale signs that the highway is being manipulated by unseen drivers. Knowledge doesn't eliminate the phantom trades, but it does give you the power to navigate smarter, preserving capital and avoiding the traps laid in microseconds. Next, we'll dive even deeper with real-world case analysis, peeling apart transaction logs and profit and loss statements to reveal precisely how these strategies play out in action. Stay with me. Let's dive into 3 vivid episodes where ghost trading didn't just whisper, it roared. You'll feel the adrenaline of a prop desk sweating under cascading losses, the quiet panic of a retail trader watching her screen implode, and the clinical precision of quant engineers dissecting the aftermath. Case Study 1: The Flash Echo in Pharma Stocks. It was a drizzly November morning when biotech heavyweight Genexus released its quarterly earnings. Revenue beat estimates, but R&D expenses spiked, and guidance came in slightly light. As soon as the announcement hit Reuters and Bloomberg terminals, the stock dipped 4% in seconds, exactly the kind of move that typically draws algorithmic buyers hunting for value. But this time, something felt off. On your screen, the level 2 quotes lit up like a Christmas tree. Phantom bids at $37.20 flashed into view, only to vanish in microseconds. Then more, hundreds of ghost bids stacked at $37.15, $37.10, $37.05. It looked like a fortress of demand. Human traders, seeing the apparent support, loaded buy orders at those levels. In the pit room, a veteran prop trader leaned forward, murmuring, "They're propping it," then executed a block buy at $37.25. Moments later, the ghost bids evaporated entirely. The price collapsed again, racing down to $35.80 before the true order book settled. That prop desk, having bought 50,000 shares at $37.25, was now underwater by nearly $70,000 in less than a heartbeat. Across the monitors, risk alarms blinked red. The trader's knuckles whitened around the mouse as he frantically tried to liquidate at the fading bids. Behind the scenes, the high-frequency firm responsible had launched an order book probe strategy earlier that morning. Their code had detected the initial dip and injected ghost bids to gauge real liquidity. When human and slow-speed algos chased the mirage, the firm reversed, selling into the momentum and pocketing a $120,000 profit before regulators even logged the orders. The net effect: a sudden echo that trapped slower participants and enriched those equipped with the fastest pipelines. Case Study 2: Retail Meltdown in Meme Equity. 2 years ago, during the explosion of meme stocks, amateur investors congregated on forums, crowdfunded rallies in GameStop shares, and watched prices soar. On a quiet Wednesday afternoon, a mid-tier brokerage app alerted users with a push notification: GME trading resumed. One retail trader, Lisa, tapped buy to add to her position. Instantly, her app showed a filled price of $194.50. But Lisa's heart sank when she checked her desktop platform minutes later. Average fill on the same block was closer to $201. Across the street, in a windowless server farm, ghost trading algorithms affiliated with a dark pool, dark venue network had intercepted retail orders. They injected fleeting sell orders at $194.50, drawing in the internalization engine of her broker. As soon as retail flow hit those quotes, the bots canceled the orders and pocketed the price improvement, trading 10,000 shares at $194.50 before vanishing into the ether. Then they sold back at $201, capturing the wider spread and leaving Lisa and thousands of other retail traders stuck with worse executions. That afternoon, retail slippage spiked by over 15 basis points, more than any single day during the meme frenzy. Forums buzzed with complaints. "My fills are trash. What happened?" Yet the firms behind the ghost orders smiled at their P&L dashboards, where algorithmic logs recorded the fill-and-kill ratio at 98.7% and price improvement capture of $6.50 per share, netting them $650,000 in under 30 minutes. Case Study 3, Cross-Asset Arbitrage in Commodity ETFs. In June of last year, a closely watched industrial metals ETF, ticker IMET, began to exhibit unexplained flashes during the thin midday trading hours. On the floor, traders noticed the ETF's price oscillating every few seconds by as much as 0.3%. Curiosity turned to alarm when a desk in Chicago reported that their algorithmic hedging strategy, tied to COMEX futures, was hemorrhaging tiny losses that summed to over $1.2 million in a single session. Quant engineers at the ETF provider pulled raw order-level data for inspection. They discovered an HFT shop launching a cross-venue probing tactic, sending ghost offers to the primary exchange just above the NBBO mid-price, while simultaneously probing hidden liquidity in two dark pools. Each time a real buyer hit one of the ghost offers, the HFT firm's co-located servers executed a true sell on the futures leg, then replenished the ghost offers a tick higher. Over 2 hours, this ghost-girding pattern repeated nearly 50,000 times, shifting the ETF's price and ripping micro-profits at each iteration. Visualize your screen flickering between quote snapshots. One moment, the best offer is $53.12. 20 milliseconds later, it's $53.15, then back down. Now imagine an execution algorithm in Amsterdam reading that flicker and miscalculating the true spread, executing hedges too late or too early, and you have the recipe for a steady drip of losses. Once the ETF sponsor identified the pattern, exchanges were notified, and cancellation rate thresholds tightened. But by then, the firm had already booked $3.4 million in profits, while counterparties reeled from unexpected slippage and failed hedges. Lessons learned and takeaways. Across these stories, 3 themes emerge: speed supremacy, illusion engineering, and regulatory gray zones. First, you see the raw advantage of co-location and micro-latency. If you can test, cancel, and trade in microseconds, you control the narrative of the book. Second, ghost trading thrives on perception. By engineering illusions of supply and demand, algorithms twist sentiment and trigger cascades of reactions from slower participants. Third, enforcement lags behind innovation. Spoofing rules target intent to execute. Ghost trading skirts just outside, exploiting the letter of the law while undermining its spirit. For individual investors, these episodes underscore the importance of skepticism and discipline. When you see rapid disappearances of liquidity, resist the urge to chase phantom bids. Use limit orders to anchor execution at known prices. Monitor execution reports for repeated adverse fills. And consider routing orders through brokers that offer maker-taker or taker-maker rebates, designed to reward limit order providers rather than internalizers. Institutional desks, meanwhile, must invest in smarter execution analytics, employing transaction cost analysis tools that parse order-level data to detect ghost-driven slippage. If you spot spikes in cancellation ratios or oscillating spreads around key events, circuit breaker-style pause mechanisms can prevent runaway losses. Firms should also adopt adaptive algorithms that vary order slices and routing venues, making their own footprints harder to exploit. Regulators are waking up too. The SEC's recent pilot programs to display more granular order book data, alongside consolidated audit trails, promise greater transparency. Yet until we see real-time policing of spoof-like patterns, ghost trading will remain a cat-and-mouse game. Exchanges have the power to enforce minimum resting times or impose fees on excessive cancellations, measures that could curb the worst excesses. But without coordinated global rules, HFT firms will simply shift tactics or venues. As we move forward, the market's equilibrium will hinge on balance, harnessing the benefits of lightning-fast liquidity while tempering the distortions of transient mirages. Ghost trading will not disappear, and nor should all forms of probing, which can deepen markets and tighten spreads. The goal is smarter regulation and smarter execution, not the eradication of speed. In our next module, we'll synthesize these insights into actionable guidelines and strategic frameworks for navigating today's ghost-haunted market landscape, and help you craft a toolkit to turn knowledge into defensive and offensive opportunities. Stay tuned. If you've made it this far, you've already glimpsed the hidden gears turning beneath the market's shiny surface. Now it's time to arm yourself with tools and tactics that let you navigate the ghostly waters and even turn those phantom ripples to your advantage. First, cultivate a habit of questioning every quote. When the bid or offer flickers too quickly, slow down. Picture your trading screen for a moment. Orders appear and vanish like mirages in the desert. Instead of reflexively chasing them, adopt a deliberate cadence. Use limit orders whenever possible. By setting a firm price threshold, you anchor your trade to reality, refusing to be swept along by momentary illusions. If the price seems unstable, tighten your limit range to avoid unexpected slippage. Over time, these small price protections compound into meaningful savings, millimeters of edge that guard your capital against the ceaseless churn of ghost liquidity. Second, monitor your execution quality with relentless discipline. After every trading session, review your fill reports side by side with the NBBO, National Best Bid and Offer. If you see consistent fills at the far end of the spread, that's a red flag. Imagine a dashboard that charts your average execution cost against the mid-price. When your line drifts upward, it's a signal you're paying the ghost tax. Ask your broker for full transparency on payment for order flow arrangements and internalization practices. The more you understand how your orders are routed, the better you can choose execution venues that treat your limit orders as maker rather than taker, often yielding rebates or tighter spreads. Third, diversify execution strategies across multiple venues and order types. Don't funnel every order through one exchange or one algorithm. Instead, break large orders into smaller tranches and route them using a blend of smart routers, dark pool crossings, and limit-only pathways. It's like spreading your net across different depths of the ocean. If one area is infested with phantom bids, you still have other pockets to fish. Many broker-dealers offer adaptive algorithms that automatically adjust slice sizes and venue mixes based on real-time liquidity and adverse selection metrics. By varying your footprints, you reduce the chance that a ghost strategy can detect and exploit your trading pattern. Fourth, leverage time-weighted and volume-weighted average price, TWAP/VWAP, strategies when tackling big positions. These slicing methodologies patiently distribute your orders over a preset interval or volume target, smoothing out your impact on the book. Picture a slow-motion drip feeding smaller orders into the market over several minutes or hours, rather than dumping your entire block at once into a churning arena of HFT probes. Many brokers now offer these algorithms with customizable urgency settings: low urgency for stealth, medium for balance, high for speed, so you can calibrate your execution to your tolerance for slippage versus opportunity cost. Fifth, subscribe to Advanced Transaction Cost Analysis (TCA) tools. Think of TCA as your post-trade autopsy report, revealing exactly where and when your execution costs inflated. These platforms break down slippage by venue, order type, and time of day, painting a detailed map of where ghost trading leaves its deepest scars. With that data, you can negotiate better routing arrangements or switch to brokers with stronger performance records. TCA doesn't just spotlight problems, it validates your improvements. When you roll out a new limit-only protocol or shift a portion of your flow to a dark pool aggregator, TCA metrics will confirm whether your adjustments actually squeezed out the ghost tax. Sixth, keep an eye on cancellation to execution ratios in the markets you trade. Most exchanges publish consolidated order book statistics showing total messages broken down by ads, fills, and cancels. When cancellation rates spike above 90% during normal trading hours, you're witnessing ghost-heavy traffic. Chart these rates on a separate live feed and tighten your own trading windows when you spot abnormalities, especially around scheduled events like earnings releases or economic data dumps. By pausing or slowing your participation during these ghost-heavy periods, you avoid stepping onto a minefield of short-lived liquidity. Seventh, develop the habit of layering orders around key technical or fundamental levels rather than slamming market orders at the NBBO. Imagine the S&P 500 ETF bouncing near its 50-day moving average. Instead of instantly snapping up shares at the prevailing bid, place small limit orders just inside that moving average line, ready to catch real liquidity without paying the ghost surcharge. This approach requires patience but rewards you with price discipline. You'll often capture genuine support and resistance levels rather than artificial price blips. Eighth, use proactive pause mechanisms on your own execution algorithms. If you manage an automated strategy, build in thresholds that temporarily disable trading if certain metrics go awry. For example, if resting times for your orders exceed 500 milliseconds or cancellation rates top 95%. In human terms, it's like slamming the safety off a runaway train. A brief cooldown lets you diagnose whether a shifting market regime or a lurking bug is dragging you into ghost territory. Ninth, stay informed on evolving regulations and exchange rule changes. Earlier this year, several regional exchanges began piloting mandatory minimum resting periods. Orders must remain on the book for at least 500 microseconds before cancellation. Others are testing cancellation fees to disincentivize excessive order churn. By tracking these developments, you can anticipate where ghost trading might migrate next and preemptively adjust your execution playbook. Subscribe to exchange rule updates and join industry forums. It's not just background reading, it's strategic intelligence. 10th and finally, build a network of peers and experts, attend webinars, read white papers from reputable execution consultants, and share anonymized TCA benchmarks with trusted contacts. The ghost trading battlefield is lively, but it's not secret. By pooling insights, like emerging ghost strategies around cross-asset arbitrage or new machine learning-based probing, you sharpen your own defenses. In this community of practice, every gain is magnified, and every mistake avoided saves not only your firm's dollars, but the collective capital of everyday investors who rely on a fair and transparent market. By weaving these 10 tactics into your trading regimen, you cultivate a resilient execution framework, one that filters out the noise of specter orders, preserves your edge, and lets you operate with confidence even when the book flickers with ghostly apparitions. The market will always evolve new tricks, but armed with limit orders, TCA insights, venue diversification, and strategic patience, you'll stay one step ahead of the invisible dancers. Up next, we'll wrap up with a concise conclusion and a call to action, how you can share this knowledge, engage with our channel, and summon your own market insights in the comments below. Stay with me, the finale is coming. As the screen slowly pans upward, the final echoes of ghost trading fade, leaving you with a clear view of the market's true architecture. We've journeyed from the flashing servers of high-frequency colocation centers to the microscopic probes that sculpt our order books. We've dissected the anatomy of phantom bids, witnessed real participants ensnared by synthetic liquidity, and explored the gray zones where code outruns regulation. Now it's time to bring everything into focus and chart a path forward, one where you, the informed trader, hold the reins. First, remember the core pillars of this adventure: speed supremacy, illusion engineering, and adaptive defense. We saw how microscopic probes test hidden depth, how momentum ignition flips price in milliseconds, and how cancellation to execution ratios can signal an invisible hand at work. We explored case studies, from biotech flashes and meme stock meltdowns to cross-asset arbitrage in commodity ETFs, that illustrated the human cost and algorithmic profit. Each story reinforced that ghost trading isn't a fringe tactic. It's woven into half of all U.S. equity volume, shaping spreads and slippage for investors at every level. Next, consider the armor you've acquired. You've learned to question every flicker on your screen, to wield limit orders as anchors in turbulent waters, and to parse your NBBO execution reports for signs of ghostly distortions. You've discovered the power of venue diversification, slicing large orders into stealthy TWAP or VWAP sequences, and harnessing transaction cost analysis tools to expose hidden fees. You've seen how pause mechanisms and cancellation threshold alerts can serve as emergency brakes when the market's pulse quickens, and how staying abreast of regulatory pilots, mandatory resting times, and cancellation fees gives you strategic foresight. Imagine the closing shot: the market's landscape stretched out like a digital map, with every ghost strategy and regulatory rule plotted in vibrant color. Now picture yourself navigating that map with confidence, guided by the insights and tactics we've shared. You no longer trade blind, you trade with purpose, spotting potential mirages before they form, adjusting your strategy with adaptive algorithms or manual discipline, and defending your capital against the invisible currents of HFT dominance. Before we wrap, let's make this personal. If you've found value in these lessons, hit that like button now. Watch as animated confetti cascades across the screen in celebration of your newfound edge. Then subscribe to our channel. Notice the bell icon shimmering beside our logo, inviting you to join a community of savvy investors who refuse to be outpaced by machines. Drop a comment below and tell us, what's the ghost trading tactic that surprised you the most? Have you ever felt the sting of slippage on a sure trade? Your stories help us sharpen our analysis and empower fellow viewers. In the description, you'll find links to further reading, white papers on order book dynamics, demo accounts for testing limit-only algorithms, and sign-ups for transaction cost analysis platforms. We've also included a downloadable PDF summary of today's 10 practical strategies. Print it, pin it, and refer back whenever your execution quality needs a boost. And if you want deeper dives, check out our playlist on algorithmic ethics and HFT regulation, where we unpack the evolving policy landscape shaping tomorrow's markets. As the video fades toward the channel outro, you'll see a burst of animated text reminding you to subscribe, like, and share. But more importantly, you'll carry these insights into your next trade, armed with skepticism for phantom orders, confidence in disciplined execution, and a community ready to support your journey. Together, we can illuminate the shadows of high-speed markets and reclaim clarity in a world built on microseconds. Thank you for watching Ghost Trading Behind the Stock Market. If you're hungry for more stories that blend cutting-edge finance with real-world impact, hit subscribe and ring that bell. Until next time, keep your orders anchored, your analyses sharp, and your trades ghost-proof. We'll see you in the next video.